How banks use asset liability management to mitigate interest rate risks. In the finance world, interest rate risks loom large over banks and financial institutions. As interest rates fluctuate, they can significantly impact a bank's profit margins. To navigate this challenge, banks employ a strategy known as Asset Liability Management, or ALM. Let's delve into what ALM is and how banks use it to mitigate interest rate risks. What is asset liability management? Asset liability management refers to a strategic approach that banks use to manage their assets and liabilities in a way that minimizes risks related to interest rate changes. The core objective is to ensure that the bank can meet its financial obligations without suffering significant losses due to interest rate fluctuations. Banks have assets that earn interest, such as loans, and liabilities that incur interest, such as deposits. The balance between these is crucial. Proper management of this balance ensures the bank remains profitable and financially stable. Importance of interest rate risk management. Interest rate risk arises from the possibility that changes in interest rates will impact a bank's earnings and the economic value of its capital. For example, if interest rates rise, a bank may have to pay higher rates on deposits while earning less on loans, squeezing their profit margins. Conversely, if interest rates fall, the bank's loan revenues may decrease while maintaining higher rates on liabilities. Effective ALM helps banks to anticipate and respond to these changes, enabling them to enhance profitability. By understanding interest rate movements, banks can position themselves to benefit from favorable trends. Control risks. It minimizes potential losses and stabilizes earnings against unpredictable market conditions. Comply with regulations. Many jurisdictions require banks to have robust risk management frameworks in place, including ALM. Key techniques in asset liability management. Banks utilize several techniques in their ALM practices to mitigate interest rate risks. Gap analysis. Gap analysis helps banks assess the difference between assets and liabilities that are subject to interest rate changes over specific time frames. This analysis helps identify periods where the bank could be at risk if interest rates move. By analyzing these gaps, banks can take actions, such as adjusting the maturity profiles of loans or deposits to align their interest-sensitive assets with liabilities. Duration analysis. Duration analysis measures the sensitivity of a bank's assets and liabilities to interest rate changes. By calculating the duration of both sides of the balance sheet, banks can determine their market risk exposure. If assets have a longer duration than liabilities, the bank could face losses when interest rates rise. ALM strategies may involve adjusting the portfolio composition to achieve a better duration match. Interest rate swaps. Interest rate swaps are financial instruments that allow banks to exchange interest payments with other parties. For instance, a bank may agree to pay a fixed interest rate in exchange for receiving a variable rate. This helps the bank stabilize its interest expenses and manage exposure to rising interest rates. It's a flexible tool that can be tailored to match the bank's specific risk profile. Scenario planning. Banks also engage in scenario planning, where they assess how different interest rate environments could impact their financial health. By simulating various scenarios, banks can devise strategies that will ensure continued profitability regardless of market conditions. Regulatory frameworks. Finally, banks must adhere to regulatory guidelines that dictate how they manage interest rate risks. Regulatory bodies often require banks to report their ALM practices and assess the effectiveness of their strategies to ensure systemic stability. In conclusion, effective asset liability management is essential for banks to mitigate interest rate risks. By employing techniques such as gap analysis, duration analysis, and interest rate swaps, banks can safeguard their operations, ensure compliance, and ultimately enhance profitability amid changing economic conditions. Ready to elevate your treasury expertise? Become a Global Banking Hub member to access exclusive courses, earn certificates, and get personalized feedback. Join now at www.globalbankinghub.com.